So we have a lot of interesting news articles and things like this that are always showing up in our email inbox. Most recently, there was one that was titled "The Home Flipping Rates Plunge During the Second Quarter of 2018." Quote, home flipping in the United States hit a 4-year low during the second quarter of this year, 2018, according to Adam Data Solutions. About 1 in 20 home sales transacted from April to June of this year was a flip, down slightly from last year. Adam Data defines a flip as a property that has been sold more than once in a 12-month period, end quote. So you dig into that article a little bit, and then you realize that the plunge that they're really referring to is a plunge in what percent?
That would be 5%, which is not a plunge. So Adam Data didn't report a plunge. They reported the decline, and Realtor Magazine reported it as a plunge. And I can't, for the life of me, figure out why anybody, especially Realtor Magazine, would be trying to create a perception of distress where it doesn't exist. Okay, so here's what the headline should be: because the housing market is so healthy, there are less distressed properties out there to buy and flip. That's what this story says. Okay, so 2018 is an excellent year in real estate. So is 17. Home flipping depends upon a situation where a house is in such bad condition and the owner does not have the money to fix it up themselves that they're willing to sell it at a deep discount just to get out. Right? And there's an opportunity for a flipper to come in, buy a house that needs $25,000. Like, here's the numbers, okay? You buy a house for $100,000, you put in $25,000 to fix it up, and it's worth $140,000, so you make $15,000, or it's worth $160,000. Okay, that's what flipping's all about. You buy it at a discount, you renovate it efficiently, and then turn it over quickly and make a profit. But when you see home sales at you see the rate of home flipping is at a 4-year low. The reason why home flipping is at a 4-year low is there's almost no distressed properties left out there. Investors have been all over this for 10 years. The housing crisis created a real dinner bell effect of a lot of people coming in to buy distressed properties that were either dilapidated, like I just described, or it's a seller who's in a distressed situation. They're underwater, they want to get out, or it's a bank that's got a gazillion foreclosures and they want to sell them as fast and as fast as they can, which means they have to sell them cheaply. Big opportunity. That situation is now fully recovered. All right. And so when you have flipping is down, it's because the market is healthy. That makes sense?
That makes sense.
Home flipping, plunging means there is such a massive number of people that want to buy flips. They can't find them because the market's so darn healthy that there aren't that many distressed properties. There aren't that many distressed owners, and everything is actually pretty good. So you'll have to ask Realtor Magazine while they headline that story with home flips plunged. They said it as distressed inventory dries up, but still, plunge. Plunge means bad. Right? This is actually a good news story because there's not as much distress.
So why are they pushing this out to be a negative thing? Who is it impacting negatively?
Because they don't know anything about real estate investing, and plunging gets you picked up in Google search results.
Hey,
not that I'm cynical.
Yeah, I'm going to start using the word plunge more in my articles. How about that? I think that sounds like a great idea.
Hey, go do a Google search for good housing news, and you're going to see not a lot. You go do a search for housing recession 2020. You'll see 9,000 pages of results because they seize upon the negative. And you could speculate onto their motivations. If it leads, it bleeds. Could be it. Could be something else. But Realtor Magazine is allowing themselves to get pulled into that game right now. Here's the point. When something goes down 5%, it's not a plunge by anybody's definition.
That's right. Now, that's right. A correction is defined as being at 20%. A plunge would be
more than 20%,
40,
then, right?
30, 35.
What's a collapse? If it was down 2.5%, it'll be a collapse?
I mean, it could be trending in the collapsing direction. How about that? I think we can spin it to be
like, I wonder what they do. Like, if they're driving their car and they realize that their car is getting low on gas, do they say that my gas tank is melting down? I'm having a meltdown. I'm having a collapse. It's like, no, your gas is not plunging. It's just down because I don't know, man. It's not a great analogy, but I'm getting worn out a little bit on this. I have to defend positivity in this market. It's the wrong thing to be negative and fearful when times are good. It's the right thing to be confident. Right now, there is only reasons to be confident, but yet I'm confronted with stories like this that use buzzwords like plunge incorrectly. Second paragraph, they explain it's only 5%. So how do they look themselves in the mirror? How do they expect to maintain credibility? And I'm not picking on Realtor Magazine. It's pervasive. How does anybody expect to maintain their credibility when they start using superlatives about minor world occurrences? It's just not that big of a deal.
No, I'm with you. All right, next article, which I thought was also kind of interesting, trending a little bit to the negative on this as well. But I think in this article, they're talking more about the retail home buyer. So. Obviously, California, and this can go for any expensive city across the United States. Of course, New York, Seattle, California is just one of them as well, and state as well. The rising home prices may be discouraging California buyers. Quote, rising home prices and higher interest rates may be discouraging housing activity in the California markets, although median home prices in Southern California still rose nearly 6% in July. And this was the weakest annual growth in 18 months. While prices are still much higher this year than last, there's an unusually smaller gap between them, end quote. What are your thoughts about the California markets? Generally, I look at California as kind of a leading indicator of what's going to happen in terms of activity in the United States on a macro level, and then I'll be able to dive down into the submarkets and micro markets and see what's really actually going on. But what are your thoughts on this? Are they referring more to the retail side? Are they referring more to the investor side? What's up?
Well, I think it's all the above. I think what's happening is basic supply and demand, right? So home prices are going too high. That's discouraging home buyers because they don't want to pay those prices. And what happens next is either somebody does jump in and buy the house. I mean, it's always, I think, useful to take macro housing stats and actually picture it with one seller selling a house to one buyer. So if you use that micro example to illustrate the macro trend, what you've got is a guy who's got a price on his house that's too high. The one across the street sold for 500 grand. He wants to sell his for 600 grand. All right, because last year the other guy sold his for 400. That guy got 500. I'm going to get 600. But the buyer says, no way. I'm not going there. It's not worth 600. I'm too smart for this. I'm not going to buy. 6 months goes by. That guy has got 600 grand on his house. He decides to bring it down to 550. Maybe now it sells. If it doesn't sell, he sits around for 6 more months. Then he brings it down to 525 and it sells. That's a healthy interplay of supply and demand. If prices go too high, they need to level off and quiet down a little bit. And the reason why they do in a healthy market is the buyers and the sellers have a standoff and the sellers blink and they lower their prices to meet demand.
So in terms of investor activity, should this be a bad thing? Should I be worried about this?
No, I think, well, California is off limits for investors to generate a yield right now anyway.
Yeah.
Meaning you can't rent the houses out enough to cover the prices. I think I look at it as whenever you see healthy market dynamics in the housing market, that means things are okay. All right. That means that, yes, if California's prices have been going up, they just said in the article, you just quoted it, they're up 6% year over year, which is the lowest rate in years, which means it's been 7 and 8 and 9%. That's too much. It's too much. So now it's quieting down. Any market around the country that has had too much appreciation, it's gotten too hot, that's got to quiet down and level off. Otherwise, it may go too far, and then it actually has to give some back, and that you don't want. So I view this as exactly what you want to see happen if appreciation's been a little bit out of control. Let it quiet down, let the world catch up to it, and I think you'll see it in other places that have gotten a little bit overheated.
And I think this is also an opportunity where investors should start looking at other markets. Like you said, it's not like California is primed up for the investor market anyway. Makes sense if you have a few $1 million to invest for 200 square feet of space. But if you want a little bit more yield, come check out Alabama or Georgia or Chattanooga, Tennessee, or somewhere in the Midwest.